All right. I'm here. Well, I'm actually not. Well, I'm here in my place, and Yoni is in his place. But joining me on the very occasional Random Walk interview podcast series is Yoni Rechtman. Rechtman. I'm not sure how to pronounce your name, but who is at a venture firm called Slow Ventures, and the rough outline of what we're going to talk about is around a thesis called the Growth Buyout thesis that Slow and Yoni just put out. I'll let Yoni do most of the talking, but it's great to have you here. Thanks for joining. Yeah. Any other quick introductory remarks before we kick it off?
No, just excited to chat. And it's
Great.
Rechtman, but you're
Rechtman.
yeah. This the
My
CHT is
instinct my
hard in
instincts were
English.
good. Yeah.
Yeah, yeah, yeah.
Got it. Okay. So I guess just really quickly, if you don't mind, what's the 2-minute version of what's Yoni's, where are you coming from? Where are you now? Where are you
Yeah.
going?
So I'm a principal at a venture fund called Slow Ventures. The history of the firm is about probably 10 or 15 years old by now. Started off as an angel group from some early Facebook people, cutting checks from their own pockets, then raised capital from a bunch of individuals and friends, and then eventually started raising and deploying institutional capital. So today we manage a total of about uh, probably about 900 million spread across 5 seed funds and 2 opportunity funds. And we invest across, we're generalist investors. We sort of take the approach that our business is investing, not like deep domain expertise on any of the categories that we care about specifically. So I've been here for about 2 years. I came here by way of another venture fund called Tusk Ventures in New York. We shared a number of portfolio companies with Slow. I got to know the team at Slow. They became, friends and mentors, and I made the move over about 2.5 years ago. So very, normal venture story. And I spent 5 years at Tusk. It's a very like normal
Got it.
story of how you make those kinds of moves.
And are you before Tusk? Were you like an investment banking
I was
analyst?
in. I was no. I went straight to the buy side from undergrad. I actually spent a year, my final year at NYU, working full time during the day at Tusk and taking night classes. So I hit venture at a really awesome moment when there were definitely far fewer seats than today, but the competition for those seats was you know minuscule, and just got really lucky, caught a cool wave, joined in this kind of crazy expansionary moment, which was really great for some reasons. Deal velocity was really high, experimentation was really high, and bad for other reasons. You pick up bad habits, you sort of bake in bad assumptions about the physics of capital markets. Um, and definitely the last, and I think this will lead into what we're here to talk about, but the last probably 2.5 years has really been, I think, led to a lot of humility and beginner's mind, and trying to do real first principles thinking about like what we're doing here and what our capital is for, and what the, like I said, the physics of capital markets overall, as we moved very definitively from one era to the next. My last day at my prior firm was December 15th, 2021. So like really, really
Ooh,
top tick.
peak.
Started at,
Yeah.
yeah, truly peak, and started at Slow March 1st, 2022. And basically came in and was like, oh, everything I've learned through 5 years of investing is worthless. Like I
Yeah.
know words and terms and what the documents look like, but overall, I mean, it all goes out the window. And spent a long time not doing a lot of investing, and instead doing a lot of like deep work, deep thinking about what we're actually doing here, which I think has led us
Got
to
it.
a lot of ideas that we might have been working on before, but have now come at, I think, with renewed focus and conviction.
Tusk is actually interesting too, right? They're a little differentiated. You're not
Yeah,
your usual venture firm.
totally. For context for listeners, the story at Tusk is also a really cool one where they started out as a consulting firm, did work for Uber in probably 2015 or so. So the big sort of New York City Hall fight and keeping Uber live in New York, wound up getting paid in equity for that. Did more of those kinds of deals, and then wound up raising a fund first to invest in the companies they were working with, and then later to invest in other companies that they sort of could bring a similar kind of strategic edge to, and had a really great experience there. I sort of give the advice to everyone: if you're going to come into venture, either like do stuff that go to an emerging manager, do stuff that's a little bit weird and novel and untested, and have a lot more room to be a part of figuring it out and making it work, or like go to the Death Star and treat your first job in venture the way that you would treat a investment banking analyst job. So I definitely had one of those two experiences, and it was an awesome place to get going.
Right. And it's sort of, and the context helps, because if, just to put a little finer gloss on what you were saying before, is like, if, certainly the last couple of years, but even before then, if, I don't know, it's a little uncharitable, but you could describe venture as, I don't know, almost like it's very much a momentum trade, right? It was just kind of like putting in money.
I don't think that's uncharitable. I think I think even the momentum traders would, in fact, I think the momentum traders would concede that point, or even explicitly make that point. It's kind of like the scene in, The Big Short, where Steve Carell says, why are they confessing? And his colleague says they're not confessing, they're bragging. Exactly. I think a lot of venture capitalists would sort of take that same approach, or you or I might say, like, why are they confessing to just being momentum traders? And the answer is they're not confessing. It's a point of pride, spotting momentum, winning access to the high momentum things, piling on. Like that's the business as a lot of venture capitalists conceive of it.
Right. The skill set was raising money to deploy money quickly, so that you could raise more money, deploy it more quickly.
It's the difference between it's see win versus pick.
Yeah, exactly. But people, it works, right? I mean, momentum trades do work on the way up. They're just not so great for the bag holder on the way down. But either way,
the problem with momentum trades in venture, maybe we're getting too sidetracked. We're not actually talking about the thing, so I'll shut up in a second. But the problem with momentum trades in venture is that the only way you can make money on it is if you are doing it like super late stage, because otherwise, exactly like you said, it's buying an illiquid asset with effectively with leverage. By paying, which is really what you're doing. If you're paying like way out for the out years, it's the same effect as buying with leverage. Like, is just a crazy, like yes, it works on the way up. The problem is the bag holder on the way down is you, unless you're doing it like the way to do it successfully is like the people who, sort of invented the concept of growth, or, pre-IPO rounds in the aughts.
Yeah, and take some of your stuff off the table if you're an early stage, and return some money. Yeah, I mean, they're right. But so we couldn't. We will come back to that. But the point here is like, in contrast to the last couple of years, there's now, I think, a premium on being differentiated and actually having an investor approach where you're making a combination of qualitative and quantitative distinctions. It's not just shoveling money into a machine, knowing that there's going to be more money behind you. So like being smart and different, and thinking about the product, like as a capital markets product, what venture is and what it does and what it's good for versus what it's not, is pretty important. And so I think that's sort of like, and you guys have stood out in that regard, and with thoughtful stuff, including, I think, the subject of today, which is, I think it was a couple of weeks ago, you put out a deck, and I'll just read the title, Growth Buyouts, the dawn of the GBO. And at that, I'll let you do. So what is that? What is the thesis?
Yeah. So I think there's two separate ideas that we have to try and reconcile that are contradictory. On the one hand, deep belief that the opportunity for technology broadly, software specifically, to orchestrate and accelerate real world productivity and the real world economy is vast and by and large untapped. And then the contradictory idea is that the opportunities to sell for software companies to sell software to non-software companies is like rapidly diminishing. And or we have run out of the easy wins, especially in, either harder industries or more fragmented industries or just real economy companies. And so trying to reconcile those two ideas, where it became increasingly obvious to us that, or it has become increasingly obvious to us that so much of the software market suffers not from product problems, not from technology problems, but from go-to-market problems. So when you see markets that you say, hey, like the home healthcare market, it's a huge industry. The total revenues are many, many billions. There's all of these obvious inefficiencies in the market, in how these companies operate. It's very pen and paper. It has all the characteristics of what should be a software market. It's existed for a long time, and yet there is no, there's no like single big software outcome, let alone a whole field. It begs the question that like this doesn't seem like a problem that gets solved through better products. It instead has to get solved through like a fundamental rethinking about how software gets deployed. And as you start working down that, yeah.
Oh, sorry. No, I was just gonna say, like, in other words, like in some ways, if before, like, we're gonna do it before, like before the thesis was pretty simple. It was like, hey, here's this huge multi-billion-dollar industry, whether it's home healthcare, construction, supply chains, like it's billions of dollars changing hands, completely analog, no software. We're going to build software to do it. Give us a bunch of money, go. Right. Like that was the general idea. Hasn't worked. Yeah. So, and I think you're sort of trying to isolate, I guess, why it hasn't worked, and then come up with a strategy that sort of better fits it. Yeah.
And I think crucially, it's insufficient to say that it hasn't worked, or it doesn't shade the problem enough to say just that it doesn't work. Because to get really specific about it, you can sell anything to anyone if you're willing to like put enough dollars behind it. It's deeply, deeply inefficient.
Right.
And so not only is it deeply inefficient, if you think about the full sort of like life cycle of customer acquisition for vertical software companies, they're often dealing in, you take the most generic version of this. These are companies that, sell relatively small dollar contracts to hopefully a very large number of customers. And at the customer level, don't monetize very well. You're talking about maybe like 1%, 2%, 3% of gross receipts. So there are opportunities to generate massive, massive amounts of value for your customers, completely transform and the P&L of an industry. But it's really, really hard to deploy. And once deployed, the value creation, value capture math is just completely busted, where you're going to spend a ton of money to sell very inefficiently, and your reward for that is like shitty subscale customers off of whom you can't generate, a big business, lots of revenue, lots of cash flow. And so as a consequence,
it's susceptible to competition too, right? Because like if you do prove that there's some accepted, right, and then somebody else can just spin up the identical software company and then maybe do a different feature or price, and
and I think that hits at a really important piece here as well, is that over time, like the moats around pure software businesses and like application software specifically just erode more and more and more to the extent that there ever was one. Like as the cost to produce software goes down, it's hard to say that you would ever re-rate vertical SaaS up and not just, and not just keep sort of discounting further as you look further into the future. Like the amount of competition for any, and you see this happening today, where there are these waves of vertical SaaS companies. Everyone wants to start an HVAC vertical SaaS company. Like it's hard to see a lot of differentiation. It's hard to see good paths into market. It's hard to believe that there are going to be big companies here. We're talking about like increasingly small slivers of the market, difficult to reach customers that you won't monetize very well, who don't care about your product. But you have all of that on the one hand about why it's not going to work. And yet on the other hand, you have like you have profound inefficiencies in these businesses with both better service quality for their customers and more profits for their shareholders that could be unlocked through software.
Right. So, like, in other words, the businesses exist. There's still huge advantages to be gained from taking a more, tech-enabled approach. But the current, venture approach to trying to access that hasn't worked. So it's like, all right, well, how do we unlock that value? So I guess we still haven't even defined, like, again, like what is the strategy? Like, what precise strategy are you proposing?
Yeah. So the basic steps, and we did not coin the term GBO or growth buyout. That was actually Metropolis, which is sort of the lighthouse case study here. This is a slow portfolio company. And I'll just walk you through what they did, which we think is by and large the recipe for how to do this, which is build software to transform the P&L of an industry. And I'm going to use the term software a lot. Software, but this applies to AI and this applies to some like hardware and robotics opportunities. Metropolis actually is a mix of hardware and software, but generically, build software that transforms the P&L of an industry. Test and validate that value proposition by selling it to customers. Use the data from those customers, use the sort of transformation and earnings lift from those customers to start underwriting acquisitions. So buy your customers, buy big players in the industry. And crucially, rather than treating it as a roll up, a series of small acquisitions, we are really, really focused on large scale transformational M&A. So we want to find, we want to increase the size of transactions over time rather than increasing the number of transactions over time. And we really want to focus on the post-acquisition value creation such that you might buy a business at 10x EBITDA and a year later, you've effectively cut the purchase multiple in half, which is roughly what Metropolis has done.
Just by improving margin, you mean, like through margin expansion?
Yes, correct.
Yeah. So even to make it simpler, let me just so, like, because Metropolis, even putting that example aside, it's like the idea is if the old model was, okay, here's this huge area of analog industry or service industry that's going on, we're going to build software, we're going to sell it to that industry, we're going to make a lot of money because everybody's going to subscribe or pay us SaaS annual recurring subscription revenue. This approach is to say, yes, we're going to build some technology. We're gonna validate it, and we're gonna fine tune it by working with some of these companies. But ultimately, rather than try to grow through a sales motion of just like hitting everybody in the space, we're actually going to buy them, right? It's like we're going to become the opco.
We are going to compete directly in the industry on the basis of proprietary product, and rather than growing a services business 0 to 1, we're just going to acquire and transform an existing one.
Right. So I guess, like, even to make it more specific, so if Metropolis is the core case, why don't you talk about, like, what is Metropolis? What do they do? What did they do now? What did they do before?
Yeah. So Metropolis is parking lot software, and they automate a lot of the work of running a parking lot. Sounds really obvious and intuitive. Like, why do I need all of these different people basically like punching tickets? It's an empty lot. Conceivably, you could run it with no people at all. The problem with selling parking lot software is that
it's really hard to park your car. Like, you have to have to take some skill. Yeah.
Yeah. The problem with selling parking lot software is that the market structure makes it basically impossible, where you have operating companies entirely separate than the asset owners. The asset owners basically want to treat this as 100% passive income. I want to own some real estate. I don't know what I'm going to do with it. But in the meantime, I can make some money. I can make some passive income by just hiring a company to run it for me. So This is mailbox money. I don't want to take calls on it. I don't want to think about it. Not interested in investing anything in it. And then on the other side, you have the operating companies who by and large aren't paid for performance. They're just paid as a management company.
They're team managers.
Yeah.
They just take some pips off. Yeah.
And they have obviously they have no interest in like investing and improving the asset because they don't own the asset. So it's basically structurally impossible. You have to get them to like think about. You have to get them to change their business model, to get them to care. And the asset owners similarly have no like strong incentive here. So Metropolis they bought a parking lot operator in Nashville, sort of a mid-size operator. They had just tremendous results in running that business, and after about 18 months, they went and just recently closed. They bought SP Plus for $1.5 billion, which is the largest public company in their category. They took it private. It's wholly owned by them, with the plan of, in sometime in the future, in the next few years, taking this whole thing, public again, with as one combined entity of SP Plus, Premier, which is the company they bought in the Southeast, and Metropolis, and it'll all just be under the Metropolis brand.
And as they buy these things, they're rolling out their software to these other operating, and similarly improving margins. So, and I presume they didn't use venture dollars to make this acquisition, right? Like they probably got debt financing or something like that. Or maybe they did.
Yeah. So we sort of think of the capital trajectory of these businesses as being, there's like a first round into the company, which is to develop software. It's not a huge amount of money. That is a very normal, seed venture equity. There's a second round into them, which is maybe their first acquisition, which is usually fairly small scale. And again, like they're a combination of venture equity and, acquisition financing debt. You can do those and think of it as like a larger seed round or a small Series A or something like that. Once you have put up a case study on acquiring and transforming a company, it's our view that you're going to basically graduate out of venture capital land and into just the wide world of capital, and it's just capital seeking a return.
Yep.
And for sure, you don't want to finance these things 100% with equity. You're going to just go toward, you're just going to run toward the cheapest cost of capital, and the world of people who understand and can underwrite this suddenly becomes really large. A lot of people can underwrite an LBO.
Can't, although they're not doing much of it lately. So, and the idea is just like, okay, this should be, you can extrapolate outwards to other models where you also have areas where either through incentives, whatever it might be, distributing this software as a standalone thing. It's not working, so you buy the opco and then you work outwards from there. So
there's
Metropolis,
there's incentive problems. There's also just market size problems. Very often the answer is that like, hey, maybe the total gross receipts of this industry is $50 billion. It's not a massive industry, but it's certainly, there can certainly be really big companies within it. The problem is that a vertical software company might monetize at 1%, 2%, 3%. So you're talking about a total addressable market size of a couple $1 billion. It's just really hard to build a scaled software company in markets that small.
Right.
And because these are not novel software markets, and they're not novel software markets where you can be hand wavy about it and say like, oh, the AI observability today is very small, but there's a good reason why in the future it'll be very big. Like, I think you're harder pressed to make that kind of argument about something that is basically a derivative of a long-standing real-world industry like pest control. Why, for some reason, the pest control TAM is actually unbounded.
Right. Or like doctor's office, anything like that, right? Exactly. You know exactly how many accounting firms there are. It's not, this is not a thing that will explode.
It might go up, it might go down, but not by orders of magnitude.
Right. And it doesn't like induce its own demand where it's, now that we know how to do this, we're going to need even more of it, et cetera. But so when it comes, just coming back to Metropolis a second, like, was this an aha moment that they had that, like, was the, we're not growing this thing.
So I think we did Metropolis before I joined Slow. But I think there was a couple of things. For one, they kind of ran into a wall. Like they knew that they had these incredible case studies from when they could make a sale. The problem was they just could not make a sale, and it was becoming extremely inefficient to grow. And they raised a bunch of money to do it, and it just wasn't. Like it was, how do we reconcile these two things where we have these like phenomenal case studies and yet nobody cares. Nobody wants to buy the product from us. And like, we know it's a big market and we're delivering big wins for our customers and we're breaking our backs to do it, not really making a lot of progress. And Alex Israel, who's the CEO there, he, I think, is a very like sophisticated capital markets thinker. And together with my partner Will, who did the investment from Slow, they kind of like dreamed up this harebrained scheme. And when they started pitching it to people, people got really excited about it, and it made a lot of intuitive sense for those who are sort of willing to like, again, think from first principles and put aside their like, oh, I'm an asset-based lender hat or I'm a private equity investor hat, and just think about like, you know, what, again, think from a little bit more first principles about like what the role of technology is in the world. And they found some really interested, willing participants to be capital providers and partners for them.
And were they like, I mean, in some ways, like, I mean, were they traditional asset-based? Like, because in some ways that's what I would have expected is like, hey, you know, venture investors would be like, no, I don't want you, you know, doing something really capital intensive, like buying a real estate. But I could see, you know, regular private equity or asset-based lender, something being like, sure, this is a cash flow asset. I see the opportunity for margin expansion. Great, this is down the middle for me.
It's more the latter, but I do think it requires, especially in the earlier rounds. So like, you know, it does require, you know, they're like, they raised capital from 3L, who is like a sort of tech and, you know, non-tech growth equity investor who I think has just been super, super forward thinking about this. And it's generally, we have found that the people who like kind of live at the crossroads of different kinds of capital, I think necessarily are more interested in and capable of thinking about like lots of different strategies or thinking about new strategies. Whereas the people who are like, hey, I'm a venture debt lender. Like I lend to software startups, but I lend like a very specific kind of debt in a very specific, you know, sort of use of proceeds. Like they're not going to get that in the same way that the people who are like, hey, I'm a software investor. You know, and this is a problem that we've certainly encountered, that it's like, to a hammer, everything is a nail. Like to a software investor, everything should be a software company, or it sort of doesn't exist at all. It's just kind of totally blind. Those people aren't gonna, at least aren't going to be quick to get it, and haven't been quick to get it. The people who maybe exist between, you know, hey, we are a credit and, you know, we do debt and equity, or we do, you know, like kind of different structured products. I think, frankly, private credit is like going to be a huge boon to this, because those are lenders, you know, who are used to like all kinds of weird and wacky structures that require like sort of holding hands with the company.
And they're less constrained by like, you know, capital requirements and things like that. They can get a little funkier. Yeah. But so I'm just curious. Okay. So like when it comes to, I mean, I'll ask two questions. Like one is like, are there any other fully scaled versions of this that you can point to? And the flip side of that is just like, couldn't you say, look, parking garages, it's a one-off, it's a commodity product, it's basically a locational rent. Nobody actually is like, oh, I like this parking garage more than the other one. You know, it's just like where they happen to be and where the traffic is. And so like, there's no, because like you talk about HVAC roll-ups or, you know, pool roll-ups or whatever it is, like there actually are, it's hard to integrate lots of different service businesses without having a meaningful trade-off to quality, right? Whereas parking garages is like, you know,
so I will answer that question, but before I do, you just said something that I think is really, really crucial to unpack, which is the use of the word roll up and talking about like integrating lots of different businesses. I think you're totally right. We draw, and if you go into the deck, you'll see that we make this distinction. We make a really hard distinction between, on the one hand, like the GBO, so, you know, relatively low volume, relatively high value, transformational M&A, with, on the other hand, the roll up, where the challenge for the roll up is acquiring at scale. So like, sourcing, diligencing, negotiating, closing, integrating with an increasing number of companies, which is really, really hard and a problem entirely separate from the question of how you improve them post acquisition. So we see these two things as being very, very distinct from one another. Sometimes we use the language of majors and minors, where GBO has as its major transformation. That's really where it's like proprietary product and IP sits. And they certainly have to be good at acquiring companies. They can't be actively bad at it, but they're willing to pay pretty high transaction costs. It's a thing that they do relatively infrequently. They need to be like sort of replacement level quality. We're going to hire bankers. We're going to hire consultants. It might take us a long time. Maybe we only do one a year. Maybe we do one every couple of years. Maybe we only do a couple in our entire life. Whereas a roll up has to really like invent process and product to scale, to go from buying 10 and then 20 and then 30 and then 50 companies, each year, which is really, really hard. We have a company that has done that quite successfully, which is Teamshares, but
I want to get to them.
We view those two things as separate but not unrelated. Like obviously the idea of using venture dollars to buy companies and using that as a way to deploy software, like yes, they're certainly related concepts, but we think it's really, really important to distinguish between the two. And I think this is going to be one of the failure modes for this category overall as venture gets really excited about buying companies, where I think a lot of them will fail on exactly that basis, where they will sort of run this as a platform acquisition business and get to the scale that most platform acquisition businesses get to, which is, they'll get to I don't know, maybe they'll buy 30 companies, and that will represent collectively like, maybe tens of, sub $100 million of EBITDA. And then they will probably just sell to a larger consolidator because they will find that it's no longer economic, buying a $5 million business and buying a $50 million business in terms of the transaction costs that you pay, not the price that you pay for the asset, but the transaction costs are like, they're not 10 times different.
It takes just as much work to do 50 million as it does 150 million.
Yeah. And so you naturally tap out in how much you can grow through small scale M&A. Again, unless you are someone like Constellation, which is like, that is their product, is buying these companies.
Right. And they know how to do it better than anybody. So like, but even like, I guess going back to first principles, like isn't part of the reason, like when I think of like large service businesses, like in some ways, like part of the reason why service businesses are so fragmented and why these markets have been so hard to access from like vendors' perspective is like, it's the nature of service businesses, the relationship driven, they're going to be fragmented. So even the large ones are in many ways lots of small businesses within a big one. Like if you think of like advertising or I don't know, even law firms or things like that, they have some shared culture, but like trying to roll out a single piece of software across a huge service business is a nightmare, right?
I think you're hitting on something that's important, which is I don't think is an immutable law of the universe, but by and large is true that this is going to work better in like relatively more commodity industries with relatively more sort of like rote work. We often talk about this as the distinction between, sort of like transforming the work and transforming the work around the work. I think it would be really hard to like buy, a film production company and say like, we're going to use technology to make better movies. Like I'm somewhat skeptical of that. I'm sure that you could run all kinds of back of house, operational things that would like materially improve profitability, but I'm not sure that would be enough to like compensate for the fact that like the movies that you're making are highly, highly variable, as opposed to, say Main Street services companies or, like an industrials business or where there's maybe a higher level of objectivity and you can sort of, and you're really just looking to solve for variation through good process.
Got it. That makes sense. So I guess let's talk about Teamshares also, which is a super interesting. I mean, you actually have a couple case studies in the deck. One, the other, actually, before we even get one of them was Orange Theory, right? OTF.
Well, so Orange Theory, we in the deck we highlight franchises as as another sort of like related but not the same concept, um, where franchises are this phenomenal way to scale IP, but to do it without owning, to do it without owning assets really at all. Like
Yeah.
I look at Orange Theory as a business that really has great IP. I don't think that principally it's like software driven, but we do think in the future you will have more software driven franchises. Once you have that IP, it's just this question of how do you scale it, and you could scale it by by selling the IP. You could scale it by buying companies. You could scale it by rolling up companies. You could scale it by sort of licensing it. And the licensing example is really just what a franchise is. So we
Right.
see all of these things as different answers to the same question of how can we scale technology in categories that have been resistant to adopting it profitably thus far.
Yeah, and it's in some ways it's the kind of you prove it a little bit first, and then you acquire
Yeah.
distribution rather than try to build it.
Yeah.
All right, so let's talk about Teamshares. What is like they're just a super unusual company. It's not even
Yeah.
entirely
Yeah.
clear to me
Team
why
shares
they're
is
why they're a venture company, but yeah, go ahead. So what
team,
are they? And yeah,
Teamshares is an awesome company. They are basically a platform to transition like long-standing small businesses to employee ownership. So what Teamshares does is they buy companies from retiring owners, and I think it's really, really important to note they are exclusively buying like long-standing businesses with consistent long-term profits. They're not buying Amazon sellers. Um, so Teamshares buys
that could never
uh,
go wrong though. Why wouldn't you want
yeah,
Amazon sellers?
exactly. Could never go wrong. So
Yeah.
Teamshares buys businesses from retiring owners, um, and over a period of years, sells it back to the existing employees of the business, um, such that upon acquisition, Teamshares owns about 10% of the company. 10% stays with the existing with the seller. 10% goes into an ESOP, or into an employee stock option plan. And then over a period of years, the balance of the company shifts towards the employees as Teamshares is basically dividending itself out, and so the employees wind up making more money because they are getting dividends, um, and eventually they own a piece of they own like an appreciable piece of the company, and the business keeps going, keeps operating indefinitely. You buy a 25-year operating business on the assumption that it'll keep operating for the next 25. Um, so Teamshares' product is really all around its ability to scale up the number of acquisitions that it makes without meaningfully growing the size of its transaction team. The business just doesn't work if they have this like one-to-one ratio between, hey, each person on our transaction team can do 10 deals a year. So to do 100 deals, we need 10 transaction people. Instead, like trying to both come up with a really, really tight buy box, but then also product to, start to automate things like P&L reconciliation and Q of E and, all of that kind of diligence work that otherwise takes a ton of time and is really sticky. And that's allowed the business to scale. Um, as they now own about 100 companies in total, they're in a position to start pushing out some really cool software products to all of those companies. So basically becoming their own neobank. Um, and that means centralizing really all of the accounting across all of their portfolio, putting companies on their own corporate cards, becoming a PayFac or a payment facilitator.
And they charge the hold codes for this, or they
So
how does that work?
they
Charge
make
for
money they make money in three ways. So for one, uh, they are a portion of the cash flow of the business goes to buy out and Teamshares and retire their shares. Second, they charge a platform fee to the business for access to the to the cap table management and the tools, and then thirdly, the business has become more profitable by using by they can basically take these shared costs, and it's sort of an accounting question. Do you turn it into revenue? If you're like getting 1% cash back, do you turn it into savings? It's sort of just how you allocate it. But either way, that's how Teamshares makes money.
And then you, as the venture investor in Teamshares, like, what is if they're slowly divesting themselves of their portfolio companies over time? So it's not like you're buying a baby Buffett or something like that. Like what are your it's a call on the software platform?
They're never going to divest down to zero. They'll sell down to I don't remember what the exact number is, but it's either high single digits or low double digits is the target. They're going to do that over a period of 20 years ish. So it takes a long time. And they're going to keep making money through share buybacks and the platform fees. And they'll make money off the platform fees in perpetuity. So we do sort of think of it. Baby Buffett's maybe not exactly the right analogy, but it's pretty close. Like, one of the beautiful things about this business, and the reason why it's structured the way that it is, to your point on like, what's the role for venture? Like, it doesn't make sense to say we're going to buy and then sell. Like, you can't dispose of these assets. That's sort of the whole problem, is there's not an efficient market for $5 to $10 million companies. It's a deeply inefficient market. And so there is no buyer at the end. That's why it's not structured as a fund where you would say, hey, every 10 years we're going to like sell it. We'll sell it to whom? There's no one to buy.
What's not it? Teamshares, or you mean Teamshares isn't structured like a fund?
Teamshares is not structured like a fund, right, because there's no one to sell the portfolio to. There's no one to sell the individual portfolio companies to. So we think that we are going to own this like big holding company that has fingers in hundreds and hundreds of pies, making money through the share buybacks over a very, very long period of time and the platform fees in perpetuity. And obviously they'll continue buying companies forever, and sort of refreshing their exposure to the buybacks.
So it's like this. It's like SMB SaaS, but you're buying your customers and then earning it back. And then by buying your customers, that's how you solve the distribution problem. Right?
To some extent. I mean, I have sort of thought that the right comp for this is actually less like, people want to comp it to like a TransDigm or something. I've actually thought that the comp is maybe a little bit better to comp it to something like Invitation Homes, which is like, hey, we're buying this like, high quality, durable asset with like relatively predictable cash flows, and we're just going to hold it. And the hard part about that business is you need to buy tons and tons and tons and tons of assets individually. It's difficult or impossible to buy, like in the case of Invitation Homes, maybe they can buy big portfolios. In the case of Teamshares, they can't. So you have to like be really, really good at buying. And that is their major.
Invitation Homes, they were buying the same, but they were buying the same thing. Like, they were buying single family homes. It sounds like Teamshares is buying all kinds of different businesses.
Yes,
right?
they're buying heterogeneous, very, very heterogeneous businesses. They have some pools and pockets, but they buy not anything, but many things.
It's funny. The comp to me, and maybe this is totally wrong, I think of like Vista, right? Isn't that kind of Vista's? That's what they do, right? Don't they buy? I mean, the larger companies, obviously, their hope is to sell them, but they kind of plug them in to this operating stack that they've evolved over time. Isn't that kind of?
Well, I think one big distinction is that, we are not. Teamshares is not buying on the assumption that they're going to have to like run the business. So they have a program for bringing in new presidents to run the businesses. But the assumption is that Teamshares itself is not super involved operationally.
Right.
So it's a much more distributed model.
Got it. But they are building software for the portfolio. That's the idea, is that they should become better businesses and also generate, revenue to the software. Like it is a technology company. Teamshares is building software. You mentioned the
Yes,
credit card.
but I think
Yeah.
crucially the goal is not, this is the distinction between Teamshares and Metropolis, is the goal for Teamshares is not to double, triple the profits of the businesses that they acquire. It's to make changes around the margin to like help them realize some cost synergies across the portfolio. That's very, very different. They're not refactoring the acquired companies and coming in and like completely changing the way they do business. It's a vehicle for continuity. It's premised on the idea that these are really high quality businesses that would otherwise struggle to find a home because there's not a logical buyer for them. And there's certainly not a logical buyer at scale. There are, yes, like search funds are very popular.
Sure.
Michael and his co-founders, before doing Teamshares, they did a search. It's part of how they sort of they successfully did a search, which is sort of part of what led them here. But like searchers are not really the answer to large scale retirements of small business owners. The answer to that, unfortunately, in the absence of something like Teamshares, is either consolidation or business closure, which eventually then just leads to consolidation, because the thing that will come in and replace it is like the scaled competitor.
Right. And somebody else will buy it for 1.5x of revenue, et cetera, move on.
Yeah.
But I guess, and so the equity kicker, so to speak, that makes it worth Teamshares' while and with your while is the software that they're building behind it, right? Like that's the upside of the embedded up. Because if you're not, the goal isn't to, or no, maybe.
I think that yes. I think that there's additional upside in the, like, there's a base case here of just, we're buying really high quality companies and we're going to have exposure to a lot of really high quality companies. Like that is a pretty solid base case. And then there's upside on, hey, and if we become our own insurance broker, if we become our own PayFac, like suddenly these are things that make these businesses meaningfully more profitable.
Yeah. Right, because otherwise you're just falling back into that initial observation that you made, which is like, it isn't economic. Like KKR is full of smart people, growth equity, BDC companies, like they know how to go find and diligence businesses. There's a reason that they don't find the $3-5 million ones, because the juice ain't worth the squeeze. So like there's got to be something. So
Teamshares has made it's. I think what you're maybe missing here is that there's two stories. There's a sort of a supply and demand story, maybe is the right way to put it, or like there's both sides of the transaction, which is Teamshares has fundamentally made it economical to transact in this market. They don't need as many people. They have automated a lot of the process of transaction. I think they would maybe be somewhat allergic to comparison to iBuyers, because the iBuyer history is like not very good, but conceptually somewhat similar. So like brought down the cost to transact with them and improving them along the way. But so this is how we think of roll-ups, is like you have to, the base case of any roll-up has to be taking this asset that is not economical to transact with, making it economical for yourself to do so, and then just scaling the number of transactions accordingly. Right. Which is why we think the opportunity
turns out that's super hard though. Right? I mean, like, actually, I mean, revenue, everybody's discovering concepts like revenue quality, and like it actually turns out that like, the service business was, one or two key employees, and that things, all kinds of manner of fuck ups happen happen all the time when you're running these service businesses. Like,
and this is one of the things that we think is really underappreciated, and why Teamshares is a great company and a great story for us, and we're really excited and proud to be shareholders in it. We have one other roll-up in our portfolio. We are not very actively looking to fund more roll-ups. I think the number of opportunities for roll-ups is very, very limited, whereas the number of opportunities for GBOs is not infinite, but is substantial.
And what is and I have a cognizant of time here, but like what are the various inflection points that are coming to a head? Is it that there is a broad availability of good software companies that are now running into a growth wall and they're there for the pickings, or is it right? Is that what part of the opportunity?
Yes, definitely. I think that there's an increasing interest by, capital partners to fund these kinds of strategies. People are, I think, really open to like looking at all kinds of different ideas. I think some of the shine has just worn off of pure software.
Sure.
Um, and so there's a lot of like hunger and excitement about alternative business models, capital structures, go to markets.
And do you view these like, I guess, two questions that are sort of related? A is like, why does this fail? And also, like, on a case by case basis, like, do you see this as venture risk? Like, are these still 90% failure rates with 100x outcomes in the small chance that they
So
succeed, or is this more of like a
yeah,
little bit more of a
no,
distributed
so
curve?
so the early rounds of these absolutely are venture risk because we're funding a company that comes to us and says, I think I have a way to transform the P&L of an industry. I need to build some software to validate that that's right. Most of the time, they're going to be wrong. That's a really hard thing to do.
Yeah.
Most of the time, they're going to be wrong. Um, Once you get to a size where you're doing the M&A and you're doing like big M&A, it stops looking like venture risk, which makes sense because it's not venture anymore. It's just capital. And why are these? You ask like, how are these things going to fail? So we would like to be failing on that question of someone says, hey, I think I have a way to transform the economics of the business, and it turns out they're wrong. I think that's the optimal failure path. The most common failure paths in our mind are going to be threefold, and this is more time than we have, but number one is buy then build, which is going to be a really, really popular strategy. And people are going to get stuck in like the myopia of business ownership. They're going to buy a business and try and turn it around with software. And they're going to wind up building software that doesn't scale. It's like, because it's not built for scalability, it's built for this asset that they own. The second is people are going to do this at software multiples because they're going to be excited and they're like not going to really be thinking about valuation in a first principles way. They're going to be thinking about valuation as well. I invest at, 20 times, or 50 times next 12 months revenue. So that's what I do. And that's what I'm going to do. And they're just going to get blown up. And then the third is people doing roll ups in a very traditional way, doing roll ups without an eye toward the scalability of the acquisition model, and then running into scaling challenges, at something like the 30 or 40 business mark.
So when you're cutting a check, like you slow, like are you cutting the check at the ideation phase before they even built the software, or is it like we've built software, it kind of works, we can prove it in one or two cases, and then that's when somebody else steps in.
Our entry point is both of those. We will follow on into later rounds, but our entry point is I have an idea for how to transform an industry, and I have some case studies, and I believe that this can work as an acquisition model. Once it has worked as an acquisition model, it's probably not the ideal entry point for us anymore.
Right. Yeah, we're out of time, but like I guess the other piece of it that I sort of was interested in is because the other challenge, at least for venture and the kind of merging with the growth equity, is just that it's different. You need bigger outcomes in venture, and to justify the risk. And in this case, like how does that work? Like if these still are going to be, these are margin plays, like you're how big are these companies at the end of the day, as opposed to like, what you have is a pure
Look,
revenue, like both a revenue and a margin grower. But yeah,
no, no, no. I think the path for any business on a long enough time horizon, every business is valued on on free cash flow and as a DCF.
sure.
Um,
Unless there's infinite money, in which case,
yeah. Um, but on a long enough time horizon, like there is no such thing as a revenue based valuation, and all of these things collapse to look rather similar. So, like the goal for any venture capital investment should be, how do I get you know maximally large free cash flow, maximally efficiently, and time speed is an input to efficiency. That's what our business actually is. It's taking novel IP and finding ways to and novel IP, novel hypotheses, novel products, and that we think can compound really, really aggressively and throw off tons of free cash flow along the way. If we do that by investing in a services company, in a buyout, in software, in a marketplace, in like those are all just vehicles to produce the free cash flow that we ultimately want to own, and that the public markets or financial acquirers ultimately want to own. So I think,
do you see these end state companies as being $1 billion companies or $200 million companies?
$1 billion companies, $1 billion+ companies. And if we don't, we're probably not interested in doing it.
Interesting. And I don't know. I guess I have to think about it more. It's just like how many service companies work like that. But maybe, I don't know. I actually really haven't thought about it. Like, what would be what are the fully scaled comps
there are 72 publicly traded software businesses valued at over $5 billion. Like, most companies in the $1 to $5 billion range are not software companies.
Yeah, that's true. Right. So the idea is you'll find one of them, they'll get huge, but their margins will be slightly better than the competition, so they'll be valued accordingly.
Yeah.
And they'll grow. Yeah, interesting. All right. You gotta go. I'm gonna cut it off. Cool. But otherwise, this was awesome. I appreciate it.
Fun. Thanks for doing this.
Follow on to talk more. Yeah, there's I also want to do the one check venture stuff, but I'm gonna cut it off. All right. Thank you very much.
Catch you later. Bye-bye.